You're a guy that a lot of people listen to. A lot of people kind of want to know, given the economic backdrop, given the rise in rates, given all the inflationary pressures here, are you still finding opportunity out there, or are you worried?
I'm worried. We're finding some opportunities, but we're very neutral in this market. And while I'm hearing a lot of optimism here, and it really kind of surprises me, you know, we're right at the edge. You said it, the Fed are raising rates. I've always said you got to watch Taylor and listen to the bond rates. Look at the curve. So the Fed's raising rates. We have a war going on in one part of the world. We have a huge conflict in our country politically and just great divides. So it's not going to be a bear market, but I've said at the beginning of this year, 2022 is going to be a choppy year.
Real quickly, let's talk a little bit about some of those divides in our country, the political polarization. The big story of the day has nothing to do with the markets. It's the leak of a document out of the Supreme Court that seems to suggest potentially that they might be poised to overturn Roe versus Wade. If we do somehow go down that road, and you start to get pushback from some of your stakeholders to maybe not invest in muni bonds or other projects in states that don't support abortion rights, at least as we know them today here, would you be receptive to that?
Romaine, that is such a tough subject. California already bans certain states that we're not allowed to travel to as business. They don't block us from investing in them, because we do own some real estate in some of the sunshine states. I think it's going to be yet another divisive issue, and I'm sure we will hear from constituents. And it just makes it so tough. I don't know from an investment perspective how I can navigate that, but again, it's another thing that's going to divide our country. And I just see it politically as such a challenge. We have such huge issues when you think about the environment for us, disclosure, where there's just no common ground. I'm very concerned going forward that it's almost ungovernable, and this is going to make it all worse.
Where you look for opportunity, I know you're a little dour now, maybe on some of the things going on in this country as well as around the world here, but you still have to find a place to put your money, right?
Yeah, and I should have said welcome to California. Welcome to my coast, Romaine. I'm glad you're here. Inflation. We are already have an exposure to inflation-sensitive assets, and we're increasing it. So not just commodities, but even looking at countries that are linked to inflation or resource-based countries. We want to build that up in the portfolio. We think inflation's here for longer. And even though the Fed's going to fight it, and boy, are they going to fight it. I think people have to pay attention. They are going to have to raise rates. That it's still going to be here for a year. And even if it calms down below 7 and 8, it's still going to be running well above 2 for a prolonged period.
I mean, where do you think the Fed's going to end this rate hiking cycle? Some people look at it 3%, and some people are looking at 4 or 5% maybe.
I heard that yesterday here was a 3% pause. I sure hope they don't, because I think that's going to be a bad move. I think they actually have to go. I think they have to go to 4 to 5. The supply chain is still completely messed up. We're still dealing with the hangover of that pandemic and all that stimulus. It's going to take a long time to work that through. And so if they pause at 3 just because inflation's at 3, they haven't done their job. They really do have to drive it down. I think we're going to have wage inflation starting this summer. So I'm not going to say the word stagflation is a high risk. It's still a low risk, but it's got to be in the vocabulary for next year. And there's nothing you can invest in. There is no opportunity when you're in a stagflation environment.
Well, even if we get stagflation and we get those rising rates to go along with it, does that create any opportunities from a fixed income perspective? Do bonds maybe look a little bit more attractive when they have maybe a 3% yield on them?
I asked Howard Marks that question yesterday afternoon. Where do I go in fixed income? And he made a good point, which is high yield with good credit analysis is going to start being at a 6 or 7% return. As long as you're not trying to trade and flip it, then that's a nice stable cash flow. So you're right. I think especially for fixed income or for people on fixed retirement income, they're finally going to get some reward for their savings and earn some interest, albeit a lot lower. So I think you'll see us where we're very, very low in fixed income and worried about duration. this will give us a chance to go back into some other credits.
Do you worry from the equity side of it? Do you worry at all that now there's going to be a lot more competition for yield? The idea here that if you have basically a Fed funds rate that gives you a benchmark 10-year yield that outpaces a dividend yield on the S&P 500, why would anyone be chasing value or growth in the equity market?
In the old days, I would say yes, but now that we've come through the pandemic and you have this whole trough of traders who now love equities all the time, I think you're still going to see that equity churn. I think you're going to see the 60-40 portfolio shifted to 70-30, and frankly, now it's mostly 80-20.
Right.
I think it's going to take a long time for people to go back heavily into fixed income. The baby boom like me, while I'm still saving,
right,
the front end is spending down and taking money out of their IRAs.
Yeah.
So I don't think they're going to be a big fixed income investor. I think they still like that growth. It's going to be a choppy market.
We've seen a lot of money roll into private equity and alternatives of alternatives. Does that trend continue?
I think institutionally it does. I've heard a lot here at this conference about the desire for private equity to be offered into the retail market. I think that's a huge mistake from my perspective as an institutional investor, but I understand why they want to go there. I really question whether it's a good retail investment. I think retail's got to find more inflation-sensitive assets, because really they've only got equity and debt.
Right.
And they've really got to look within the equity market, and they've got to look to other baskets in ETFs to try and get some commodity play.
But that's hard for the retail investor. There aren't too many places they can go borrowing, just going out and buying real estate.
The typical 401k that's offered by a company does not have it only has equity options or fixed income options. More of them are adding real asset options, which is really the only thing that protects against inflation.
Let's talk about investing overseas here. Obviously, before the pandemic, before the trade war, China was kind of the marquee place for U.S. investors looking for international exposure. That bloom has come off the rose here. Is China still investable?
Yes, but it's been an interesting discussion here. I've seen it very polarized. Some people are very, very bullish on China. They're worried about, obviously, the current lockdown, but they look long term. China was one of the few areas where you had growth. It is the second largest economy. But now I'm hearing a lot of people realize that for the first time, finance is being used as a weapon. And when you think about Taiwan and the relationship between the U.S. and China, it really becomes a concern from a long-term investor. Can you go there and stay there? And
as an investor who is obviously knee-deep in ESG with a lot of ESG commitments, does China at all complement that or work against it?
Well, on one hand, they're the biggest manufacturer of solar panels, but no, they're a huge user of coal. And they've made a commitment to 2060, not 2050. But you need them. So you've got, everybody loves iPhones, but that's rare earth minerals, and that's mining in China. It's incredibly complex. And that's, ESG is not just simply 3 letters. It is hugely complex, and you've got to tear into the details. There are going to be a lot of interesting ideas coming out of China that will deal with clean technology and innovation that are investable.
Last question here. The war in Ukraine has caused a lot of disruptions, including in some of the climate initiatives that this country has been pursuing here. Do you think that the U.S. government, as well as the rest of the developed world, will hit its climate goals, or do you think that this sort of embrace of fossil fuels, at least in the short term, could maybe prolong that process?
Mark Carney was here yesterday. I got a chance to talk to him. He's optimistic. I hate to take the other side, but I'm just worried that people are dragging their feet. Governments are dragging their feet, and that they won't do it. And I think there's a risk we'll be at 1.5 centigrade earlier, somewhere before even maybe the early 2020s. We're going to see 120-degree temperatures in California. I hope that wakes people up, but I think we've already baked that in, so I'm not as optimistic. CalSTRS is absolutely committed to net zero, and we're going to move our portfolio, but we need companies to make that change as well.